Morning. Today's Monday, June 2nd. Happy June, everybody. Hope everyone had a nice weekend. Weather down here in Charleston was beautiful over the weekend. I feel like normally in June we are at the time of year where it's way too hot to be outside and in the sun. Whereas this weekend, my wife and I got to take our little guy to the beach, which was fun. Whereas my mom in Pittsburgh shared that they were down into the 30s overnight last night. So at any point, Mom, if you guys want to move down here, you're welcome to. Um, that being said, it is normally like too hot to go outside this time of year. So very blessed this weekend to have the opportunity to go to the beach and it not be that not be the case. My little guy with the ocean is hysterical to me. He kind of runs in and out of the ocean as the waves come in and out. Like as the water gets out, he retreats. As the water goes, ebbs back, um, flows back. I don't know which would be which, but he'll run back in, and then he finally realizes that like, oh, I love the water. This is great, and then he'll just run face first into the ocean. So that's when Dad has to step in and make sure the almost 1.5-year-old isn't going to dive in face first. So we had a very good time, very fun weekend. Looking at some market data from last week, market data, economic data, we had a handful of different things come out. Some U of M surveys, go blue. Just throwing it in there to irk Johan when he watches this, but we had consumer sentiment and then 1-year inflation. Those two numbers were both good as far as market was concerned. Nothing significant or overly significant, I guess, but those two working in tandem probably partially responsible for, or factored in at the very least to the past 6 weeks. Market's been pretty good. Consumer sentiment moved from 51.5 to 52.2. And 1-year inflation dropped from 7.1% to 6.6, so a 50 basis point drop there. Both good numbers. Kind of interesting, and I know I'm gonna sound like a shorter, balder, broken record than Johan, but this year the market has just kind of been screaming why you want to be globally diversified. So U.S. market through the first 5 months of the year, now that we've wrapped up May. Depending on which benchmark you're looking at, up between 0.5% and 1%, whereas international markets, same thing, depending on which benchmark you're looking at anywhere between 13 and 16 percentage points, like pretty significant outperformance. So it's why you want to have that exposure to international markets, particularly if you're in retirement and taking withdrawals at this point. Like, if you're taking money out of a portfolio that's stagnant or sitting flat because you're only invested in the U.S., you could be kind of a little worried about what's going on in the market. Whereas if you have at least some exposure to the international markets, it's been a pretty solid year. One interesting data point from last week's economic data was the unemployment insurance number that came through. It was just north of 1.9 million workers. It's the highest in nearly 4 years, which is alarming isn't the right word, but it's worth keeping an eye on. And then this week it'll be like kind of in tandem with that. It'll be interesting to look at. We have the JOLTS report, which is job openings and labor turnover survey and non-farm payroll. It'll be interesting to see where those numbers come in relative to what we just saw with the unemployment insurance claims that came through, to see if is that 1.9 number kind of a one-off aberration, if you will, or is it aberration? You guys get the idea. A one-off occurrence, or is that kind of a leading indicator as to unemployment potentially ticking up? If you look at how kind of futures contracts are trading with in the bond market, this is kind of an interesting. As of Friday of last week, the Fed futures contracts were predicting or kind of factoring in 3.8. It was trading at 3.88%, which represented just north of a 25 basis point rate cut between now and the end of the year. That same contract in April was pricing in or pricing a 3% rate. So a pretty significant difference, 88 basis points. So beginning of April, we're expecting more significant rate cuts, whereas now they're currently pricing in 25 bips, or just north of 25 bips. So it'll be worth keeping an eye on. And again, the Fed's mandate. Again, I know I sound like a broken record here with Johan talking about this all the time, but they're concerned with unemployment and inflation. Those are their two. It's a dual mandate. So the fact that the market's trading as if they're only going to have a 25 basis point cut between now and the end of the year makes me think that the expectation is that the Fed is more concerned with inflation than they are unemployment right now. So unless those unemployment numbers get significantly worse, I don't think we're going to see those prices move too much. But time will tell. No one ever knows what the Fed's doing. Questions, comments, concerns, do not hesitate to reach out, and hope everyone has a great week.